Want to know how to make your money work for you? Are you intrigued by the idea of your hard-earned cash multiplying without you lifting a finger? Well, you're in the right place. Today, we're diving deep into the world of dividend investing, a strategy that's been proven to turn small savings into substantial sums. So, if you're ready to take a leap into financial independence and open the doors to passive income, you won't want to miss this. Stay tuned to learn the secrets of dividend investing. So, what exactly is dividend investing? Well, it's a strategy that focuses on purchasing stocks of companies that regularly distribute a portion of their earnings back to shareholders. This portion is what we call a dividend. It's like a thank you note from the company for your faith in them, but in the form of money. Now, you might be wondering why companies distribute dividends. Companies that have reached a certain level of stability and profitability often choose to distribute dividends as a way to share their success with shareholders. It's a sign of financial health and a commitment to rewarding those who've invested in the company's vision. Dividends are typically issued as cash payments, but they can also come in the form of additional shares of stock. The frequency of these payments can vary. Some companies pay dividends quarterly, others semi-annually, and a few may even pay annually or on a monthly basis. So how does dividend investing benefit you as an investor? Well, it offers a consistent stream of income. Even if the market is having a bad day, week, or even year, if you're invested in a company that pays dividends, you'll still receive your dividend payment. It's a bit like having a safety net during market downturns. Moreover, dividends can be reinvested to purchase more shares, contributing to the magic of compounding. This process of reinvesting dividends for purchasing more shares is known as dividend reinvestment. It's like a snowball effect where your investment keeps growing over time even if you don't invest new money. But remember, not all profitable companies distribute dividends. Some prefer to reinvest their profits back into the business for further growth. These are often younger, growth-oriented companies. In essence, dividend investing is a long-term strategy, appealing to those who wish to generate a steady stream of income and potentially benefit from the power of compounding over time. Now that you understand what dividend investing is, let's delve into the process. Scene script. Embark on your journey to dividend investing with these easy steps. Step 1. Choose the right company. This is where the journey begins. Look for companies that have a history of paying consistent dividends. These are often mature, profitable companies in stable industries. Typically, businesses in sectors like utilities, consumer staples, and healthcare tend to be reliable dividend payers. Step 2. Understand the dividend yield. This is the annual dividend payment divided by the stock's current market price. A higher yield can be attractive, but be wary. An unusually high yield could be a sign that the market expects the dividend to be cut in the future. As a rule of thumb, a yield between 2 to 6% is generally considered healthy. Step 3. Check the payout ratio. This tells you what portion of the company's earnings is paid out as dividends. A lower ratio, say below 60%, suggests the company has room to increase its dividend in the future. Conversely, a high payout ratio could indicate that the dividend might not be sustainable. Step 4. Consider dividend growth. A company that increases its dividend regularly shows confidence in its future earnings. Look for businesses with a track record of dividend growth over the last 5 to 10 years. Step 5. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across various sectors and geographic regions. This can help protect your portfolio from industry-specific or regional economic downturns. Step 6. Reinvest your dividends. One of the most powerful ways to grow your wealth over time is through dividend reinvestment. This means using your dividend earnings to buy more shares of the company. Over time, this can lead to compounding returns, a powerful tool for wealth creation. Step 7. Monitor your investments. Don't just invest and forget. Keep an eye on your investments. Look out for any significant changes in the company's fundamentals, such as a drop in earnings or a cut in dividends. And finally, Step 8. Be patient. Dividend investing is a long-term strategy. It's not about making quick profits, but building wealth over time. It may take several years for your investments to start producing significant income. So stay the course and let the power of compounding do its magic. In conclusion, dividend investing is a journey that requires careful planning, diligence, and patience. It's about investing in solid companies, understanding the numbers, diversifying your portfolio, reinvesting dividends, and staying the course. Remember, each step is crucial in the process of dividend investing. You might wonder, why should I choose dividend investing? Well, let's delve into the many benefits that come with this investment strategy. The first and most obvious perk is the steady income. Dividends are essentially a portion of a company's earnings that it decides to share with its shareholders, typically on a quarterly basis. This means that even if the stock market is having a rough day, week, or month, you'll still receive your dividend payout, giving you a consistent stream of income. But the benefits don't stop there. Dividend investing also offers fantastic reinvestment opportunities. Imagine you receive your dividend payout. Instead of spending it, you decide to reinvest it by buying more shares of the same company. This strengthens your position and increases your potential future earnings. Now let's talk about the magic of compounding effects. When you continuously reinvest your dividends, you not only buy more shares, but those additional shares also start producing dividends. Over time, this creates a snowball effect where your dividends earn more dividends, which in turn earn even more dividends. It's like a money-making machine that keeps growing the more you feed it. And don't forget, dividend investing generally involves established companies with a history of profitability. This can bring a level of stability to your portfolio that growth stocks might not provide. Clearly, dividend investing has its unique advantages. It's about more than just immediate returns. It's about long-term growth, stability, and the potential for a consistent income stream. Scene script. However, like any investment, dividend investing comes with its risks. First off, let's talk about dividend cuts. Companies can and do cut their dividends. This usually happens when a company is facing financial difficulties and needs to conserve cash. The company's board of directors makes the decision to cut the dividend, often to the dismay of shareholders. When this happens, not only does the income from the dividend decrease, but the stock price often takes a hit as well, as the market reacts negatively to the news. Next up, market volatility. Stocks fluctuate in price on a daily basis, and dividend stocks are no exception. While some dividend stocks can be less volatile than growth stocks, they are not immune to market movements. This means that the value of your investment can go up and down, and there is always the risk that you could lose money. Another risk is overexposure to a single sector. Some sectors are known for their high dividend yields, such as utilities and real estate. However, if you load up on stocks from these sectors in search of high dividends, you're not diversifying your portfolio, and this can expose you to sector-specific risks. Lastly, there's the risk of chasing yield. This is when an investor buys stocks solely because they have high dividend yields. However, a high yield can sometimes be a sign of a struggling company, and this approach can lead to losses. It's important to keep these risks in mind while investing. So, what should you remember about dividend investing? First and foremost, dividend investing is a strategy focused on buying shares in companies that regularly pay dividends. These dividends represent a portion of the company's profits, distributed to shareholders as a reward for their investment. We've walked through the steps to begin your dividend investing journey, researching potential companies, reviewing their dividend history, and making an informed decision on which stocks to buy. Remember, consistency in dividend payments is a good indicator of a company's financial health. We've also discussed the numerous benefits of this investment strategy. Dividend investing can provide a steady income stream, particularly appealing for those in retirement or seeking financial stability. It also offers the potential for capital growth, as you can reinvest your dividends to buy more shares, thereby compounding your earnings over time. However, it's crucial to keep in mind that, like all investments, dividend investing isn't without risks. Market fluctuations can impact share prices, and there's always the chance that a company may cut or eliminate its dividend payments. In light of these potential risks, it's important to diversify your portfolio and not rely solely on dividends for your income. Remember, knowledge is power in the world of investing. With this knowledge, you are now equipped to make your money work for you through dividend investing. Until next time, keep investing wisely.